Internal Revenue Service IRS tax news. IRS expands enforcement focus on abusive micro-captive insurance schemes. Taxpayers urged to consult independent tax advisor before October 15th filing deadline. IR 2020-226, October 1st, 2020, Washington. With the October 15th filing deadline quickly approaching, the Internal Revenue Service today encouraged taxpayers to consult an independent tax advisor if they participated in a micro-captive insurance transaction. So obviously we have the extension that took place, and the extended tax returns for the 2019 filing are due on October 15th. And if there is anybody participating in this instance, or in this type of case, a micro-captive insurance transaction, then you might want to be consulting, because obviously the IRS is focusing on this area. So the IRS encourages any taxpayer who has continued to engage in an abusive micro-captive insurance transaction to not anticipate being able to settle its transaction with the IRS or Chief Counsel on terms more favorable than previously announced settlement offers. You can see the settlement offers here, and that any potential future settlement initiative that the IRS may consider will require additional concessions by the taxpayer. So they're basically saying, hey, this is the best offer for this kind of situation. You probably want to take it now, because they think they're gonna get tougher on the enforcement, and possibly they're running a harder deal that if you don't take the offer now. So they're basically saying this is the best offer. We're going to look harder on this and put more time and effort into it. So in any case, with this in mind, the IRS encourages taxpayers to consult an independent tax advisor if they participated in a micro-captive insurance transactions. These taxpayers should seriously consider exiting the transaction and not claiming deductions associated with abusive micro-captive insurance transactions, just like any other taxpayer did who were contacted by the IRS in March and July 2020. So if you were contacted about it, looking into it, you probably want to check it out, consult your tax advisor about it. Let them know, obviously, the IRS is looking into this more closely, so you want to make sure that you're doing things properly. For those taxpayers that do not exit the transaction and continue taking such deductions, the IRS will disallow tax benefits from transactions that are determined to be abusive, and may also require domestic captives to include premium payments in income and assert a withholding liability related to foreign captives. The IRS will also assert penalties as appropriate, including the strict liability penalty that applies to transactions that lack economic substance under sections 77010 and 6662I. The IRS Office of Chief Counsel will continue to litigate these abusive transactions in tax court. Quote, the IRS enforcement efforts will continue to these abusive transactions, end quote. IRS Commissioner Chuck Reddick said, quote, any future settlement terms will only get worse, not better. The IRS has never been better positioned in its quest to eradicate abusive transactions following the stand-up of a dedicated promoter office, a new fraud enforcement office, and enforced service-wide coordination with the Criminal Investigation and the Office of Professional Responsibility, and our advanced data analytics and mining capabilities. The taxpayers are strongly encouraged to use these opportunities to put this behind them and get into compliance, end quote. Abusive micro-captives have been a concern in the IRS for several years. The transactions first appeared on the IRS, quote, Dirty Dozen, end quote, list of tax scams in 2014, and remain a priority enforcement issue for the IRS. In 2016, the Department of Treasury and IRS issued Notice 2016-66, there's a link to that here, which identified certain micro-captive transactions as having the potential for tax avoidance and evasion. In March and July 2020, IRS issued letters to taxpayers who participated in a Notice 2016-66 transaction, alerting them that the IRS enforcement activity in this area will be expanding significantly, and providing them with opportunity to tell the IRS if they've discontinued their participation in this transaction before the IRS initiates examinations. So it's typically going to be best if you're doing something that is illegal, or that the IRS deems to be not right, to let them know beforehand, because then they're typically better. Typically have better terms in terms of penalties and interest and related to it. So back to the text. Early responses indicate that a significant number of taxpayers who participated in these transactions have exited the transaction. This summer, the IRS issued a new round of Section 6112 letters to material investors who filed with the IRS pursuant to Notice 2016-66. In addition, the IRS has deployed 12 newly formed micro-captive examination teams to substantially increase the examinations of ongoing abusive micro-captive insurance transactions. Also, as part of the IRS's continued focus on this area, the IRS has become aware of variations of the abusive micro-captive insurance transactions. Examples of these variations include certain Puerto Rico and offshore captive insurance arrangements that do not involve Section 831B elections. These variations appear to be designed and marketed with the express intent of avoiding reporting under Notice 2016-66 and yet perpetuating, in some cases, the same or similar abusive elements as the abusive micro-captive insurance transactions. So the IRS is saying, hey, it looks like you're specifically trying to avoid this notice, but it looks like the same thing. So you would think that basically in substance, it would still be something that the IRS would win in terms of if they were to litigate against it. So in any case, the IRS is aware of these abusive transactions and is actively working to counter proliferations. The IRS cautions taxpayers that in the extent they engage in variations of abusive micro-captive transactions that are substantially similar to Notice 2016-66, they must be disclosed. Otherwise, the IRS will impose penalties for failure to disclose.